Hi, Phil. Good to have you again today.
Hi, Todd. How are you?
Good. Thanks for joining us. So we normally start out talking about the macro environment, and in the past sessions, you've often referred to it as being quite heated. Has that changed for you at all?
I would say no. I would say that momentum is still very strong. Valuations are still quite high. Credit flows, credit standards, and stimulus are all pretty buoyant, and seem pretty loose. So I would say my opinions haven't really changed all that much year to date, really. I know there's a little bit of a sell-off here, but not very much of anything in my opinion so far.
Fair enough, that makes sense. Well, then maybe let's shift gears here a little bit to a different macro topic that we haven't talked about before. Let's talk about Canadian real estate. We have the election coming up, of course, and by the time this airs, that will be over, so there'll be that factor as well. So yeah, if we could just hear your opinion on that, it'd be good.
Yeah, so you're right. We are in the middle of a campaign cycle here in Canada, or an election cycle, and the housing issue is a very hot topic. It's a huge political issue for all parties in this country. And I guess from a personal standpoint or a valuation standpoint, the stock market to me looks very hot and overvalued, as you mentioned there at the top. But the real estate market looks just as overvalued or hot to me, if not worse. So from a policy maker's point of view, I think that creates a fairly serious problem. If stocks or cryptocurrency goes up by 50% in a year, it doesn't have major ripple effects through everybody living in your economy. It's nice for those who own the assets, but it doesn't have that great of an outcome for those who don't own the assets. So it creates major dislocations in your economy, and that's what's happened. Real estate prices have gone up in a big way. So it means that the country today faces a crisis for renters, would-be homeowners, and for those who have just taken on huge mortgages in order to get into the housing market. So whoever gets elected, they have the joyous job of trying to clean this up. I wouldn't want to try to clean it up, but they'll have to try, and they'll have to figure out some way to get out of the mess, and I'm not sure how they're going to do it.
No kidding. Yeah, it's certainly becoming a bigger issue. So I guess in your opinion, what do you think has driven this then, would you say?
Well, I guess we could make a whole video about that. There seem to be a lot of factors out there to me that have contributed to the current state of Canada's housing market. And I actually wrote an article on that and potential solutions on My Money Moves, my little website. I just figured I'd throw something up there for people who may want to check it out. If I were to narrow it down to the three biggest ones that I think are in play, the first one I'd highlight is the central bank. The policies of the central bank have had a very large impact on asset prices historically and on consumer prices historically, and they're doing it again here. And the two big things are record low interest rates and quantitative easing. And taken together and done together on the scale that they're doing them, it really buoys up the housing market. And then on the municipal level, there's a lot of red tape that is involved in getting projects approved, getting supply on the market, getting buildings actually built. And there's a lot of NIMBYism, a lot of backlash among neighbors when you try to develop a new project in a given neighborhood. So we've had a situation in this country where there's been years of underbuilding relative to population growth, relative to immigration flows. And then the final thing I'd say, the final big thing anyway, is I think the lending standards at Canada's banks are not as prudent as they would be were they bearing the risk of the loans they write. And in general, they don't do that because the loans are underwritten and backstopped by CMHC and taxpayers. So my guess is that if you got rid of that and you told banks, hey, you have to bear the risk of the loans that you write, there would be big changes and lending standards would tighten up.
Yeah, those are all very good points. So in your opinion, what would be the solution to this? I mean, or is there a solution at all?
I guess on those 3 points I just mentioned, with the Bank of Canada, getting rid of quantitative easing would go a long way. To me, it looks like backdoor socialism. It's a government participant acting in a market economy, and it creates distortions. And I would try to get rid of that. There's also a discussion that perhaps could be made around how interest rates are determined and whether real estate factors are properly accounted for in the cost of living, and I would argue they're not. At the municipal level, you could rezone, you could upzone, you could try to create more supply by reducing red tape, and then with same HC, you could privatize it, and that would help. Obviously, it's not palatable to do that, and all of the things I've just mentioned would be difficult. But if I were an elected official, I think those are the kind of things I would be attempting to do.
Yeah, certainly not a fun task to try to clean up, that's for sure.
Yeah, yeah. And I should also mention, I've actually joined a local group here in Victoria called Homes for a Living, which is trying to push local politicians and local city staff and developers to bring more supply onto the market and to try and alleviate the problem here in Victoria. And I'm sure there are many organizations like this throughout the country because it's becoming quite an issue. It's no longer confined to Vancouver and Toronto. It's everywhere.
Well, good for you. And it's important that people do get involved in local issues like that. So yeah, that's fantastic. Well, moving on, and perhaps fittingly, our first company-specific question is on RioCan. Specifically, what you think of their real estate portfolio 2020 versus now. What would be your thoughts?
It's night and day in my opinion. 2020 was a rough year. 2021 looks pretty good to me so far. The real estate portfolio has done very well in the last year, and this time last year, that was not the case. The second quarter of 2020 was awful for RioCan. They were getting hammered. Their rents were not coming due when they wanted them. It was down to 73% of cash rents collected this time last year. The company was rolling out rent deferral programs for many of its smaller tenants, and that was on top of government support. So this time last year, it looked pretty ugly, and the second quarter of 2020 was probably their worst quarter in maybe forever.
Wow. And what about full year numbers?
Yeah, it got better in the backstretch of the year, but the full year numbers were still pretty awful. The leverage metrics ballooned on them because their cash flows were shrinking so much. Revenues fell 14-15%, somewhere in that neighborhood. They cut their dividend, monthly distribution that is, by a third. And the company reported a net loss of $65 million. And $65 million for such a large organization, that might not sound like a lot. But to put it in perspective, in 2019, they produced a profit of $776 million. So that's a massive drop. And then going back to the financial crisis, in 2009, they produced a profit of $114 million. So it was by far and away a much more challenging operating environment in 2020 than it was in 2008, 2009.
No kidding. That is quite the comparison between 2020 and 2009.
Yeah, I couldn't agree more. The operating environment for REITs was just awful, or retail specific REITs like RioCan was just awful last year.
Yeah, and yet you guys bought more, right? In September, you bought it. What was it? $14.75, I think.
Yeah, that's true. We bought it roughly this time last year in September of 2020 when things were looking pretty bad, and we weren't trying to bottom pick it by any means, although since then the shares have almost gone straight up. They're now over $22. And I should actually say Ben was the major driver behind purchasing RioCan at this time last year. He was really interested in getting more of it in the portfolio. So my hat goes off to him because I was interested, but I wasn't confident enough to pull the trigger while he was. So I just went along with the trade, and so far it's worked out quite well.
So why did you guys pull the trigger then? What was the catalyst at that point?
Yeah, so I guess I just told you how awful the Q2 numbers were this time last year, and how leverage metrics were getting worse and all of that. And we anticipated a dividend cut, for example. But when we looked through the balance sheet, it occurred to us that the liquidity was actually okay. The balance sheet was strong enough. The dividend, if it was cut, which we all know now it was, would eventually grow again. And we thought management was being pretty proactive given the scale of the situation. And then finally, we like low-valued and undervalued companies, and the valuations on RioCan this time last year were very low. Regardless of how you looked at it, they were very low. So yeah, that's basically why we bought it and why Ben was driving to get more of it in the vice president portfolio.
Fair enough. Well, that certainly makes sense, and well done, Ben.
Yeah, totally. I couldn't agree more. And he understood the thesis pretty well back then, so good for him.
So any closing comments on RioCan before we move on?
Well, I could pitch an article that I've just written for Seeking Alpha on it. You can check it out there if you wish. And The other thing I would mention is the outlook. I would say the outlook is probably pretty good at this point. So as many longtime subscribers will know, they're more or less focused in Canada's 6 largest urban markets, and their main bread and butter is Toronto. And Toronto's issues in the housing market are meaning that RioCan should do very well. There are low vacancy rates for rental space, for retail space, for office space, and that, when you take it all together, provides a pretty good tailwind for the company, and I suspect its cash flows will chug higher in the coming years because of that.
Excellent, excellent. Okay. Well, sticking with real estate, or at least real estate related, we have a subscriber question on Bird Construction. What are your thoughts on the company after this rally over the last year?
Yeah, that's a fair question because it's rallied quite a bit. The company has come a long way for sure. We purchased it in March 2020 when no one else was buying anything at around $4.70, and today I think it's trading over $10. So I'd say the company's rally, it's pretty good, and it's no longer a buy for me as a result. But the valuations still look fine. The Stuart Olson acquisition is working out pretty well so far, and I think, as with RioCan, I think they have good macro tailwinds at their back.
And I guess by macro tailwinds, you're talking about government spending and stimulus and things of that sort.
Yeah, bingo, you nailed it. They have some corporate presentations out there which highlight how much government money has been thrown at construction and at infrastructure, and it's a staggering sum. I'll try to get you the infographic that they have, and if I'm not wrong, I think it's like $350 billion here in Canada if you add up the provincial level money that's being thrown at it and the federal level. And that's a lot of money. There's no two ways about it. That's a ton of money going into the sector.
Yeah, it's certainly a tailwind. What sort of time frame would you expect that to occur over? Any idea?
Yeah, it's going to occur over a few years. I think it's 5 or 6 years that 350 billion will be deployed. So not all at once. I don't even know how you could handle all of it at once, but that's that. And I'm speculating here, but given we're in an election cycle, we could see more spending coming out of the federal government anyway, as a new government is formed in the coming weeks. And then south of the border, Biden is trying to ram through this massive infrastructure package. So there again, there are good tailwinds for this sector as a whole.
Perfect. Okay, good. Could you tell me a bit more about the Stuart Olson acquisition and Dagmar Construction?
Yeah, so on Dagmar, there isn't that much to say. The deal was announced in August. Dagmar, for those who don't know, and most people won't, it's just a small private construction company out of Ontario. Bird paid $32 million, but I can't find any metrics around how much revenue Dagmar produced, so I can't find it anyway. So long story short, it's not a transformative deal. Stuart Olson, on the other hand, is a transformative deal. It's large, it's big, and it's a well-known brand within the Canadian construction space. And in my opinion, Bird got a steal here because Stuart Olson looked like a bankruptcy candidate when they were purchased. And had somebody like Bird not come along, they might have declared bankruptcy or done some kind of restructuring or huge share issuance or something like that. So in addition to getting Stuart Olson on the cheap, this transaction really builds their base in Western Canada. It diversifies their customer and revenue streams, and there are cost savings that they've tagged at about $25 million annually. So all in all, it's quite a good deal, and it's quite a transformative deal.
No kidding. That sounds great. Good for them. So what do you think of their recent investor day? Did you follow that?
Yeah, I did follow it. I thought, I'm going to sound cynical, I thought it was a bit of a nothing burger myself, but then again, I think most investor days are. What I really like to see from investor days are time-bound quantitative targets, a clear strategic vision, and a handful of concise actions which marry the two. And in Bird's case, I would give them 1/3 marks, I suppose, which is fine. It's no worse than most other investor presentations. So, I'm not thrilled by it, but I'm not going to change my thesis on the company either.
Okay, good. Thanks, Phil. Well, we have a subscriber question here about Fairfax preferred shares. They say in April 2020, in the quarterly email update, there were a number of non-Contra stock picks, one of those being Fairfax preferred shares. So could you comment on those purchases and what you think of them now?
Yeah, so the securities the subscribers mentioning from way back in March 2020 include the K shares, the Fairfax K shares, and the Fairfax G shares. I purchased them in my personal portfolios at $13.75 and $13.25 respectively. And today the K shares are around $23 or $23.50, somewhere in there. And the G shares are around $18 and they've had a good rally. So that's great. But I should mention that as soon as I bought these back in March 2020, they tanked really hard, just like everything I was purchasing in early 2020. And I think the G shares, for example, they fell under $10 almost as soon as I had touched them in the 5 or 6 trading days thereafter. And I remember having a phone conversation with my dad, and I just told him everything I was buying for us was tanking, and he just laughed, suggested I buy more. And we kind of just accept that's what happens in brutal bear markets. Everything tanks. So that's just the way it goes. But we also both think, I assume, is that if you can tolerate the risk, you can tolerate the volatility, you'll probably do okay to better than okay in the end. So that's how it went for these preferred shares.
Well, it's yeah. I mean, catching a falling knife is always difficult. I mean, it's a little different, I guess, when it's a macro environment sort of situation as opposed to company specific. But I mean, how do you view that sort of purchase generally?
Yeah, I think you're right about differentiating between macro falling knives versus others. I would say that I have yet to go into a really volatile period without any cash or with very little cash. So the volatility doesn't bug me so much because I have the cash to take advantage of it and to give me some ballast. And once the volatility starts, I don't go and deploy my cash all at once or right away. And I kind of think of it as when you're in a bear market, you're kind of like a soldier in a fight. You want to have the mental preparation to stay in the fight. That's the big thing. You want to have well-funded companies which act like armor, so to speak, in your portfolio. And then you want to have lots of ammunition and cash which you can continue to fight with for a long time if things don't go your way. So yeah, I mean, when downturns happen, I don't try to pot and pick. I just try to chip away at companies I like, either adding to new positions or taking on some bigger positions in old companies that I know well. And hopefully I can do that again in the future.
That's some great advice, really. Yeah, so I'm sure subscribers appreciate that. Turning back to Fairfax Preferred, do you continue to hold them, and are you going to, or where do you stand there?
Yeah, I continue to hold them. I have no plans to sell them at the moment. When I bought them, I just thought I'd hold them, get some dividend income, hopefully get some capital gains. And that's happened so far. The dividend income has been good. The capital gains have been good. I don't anticipate capital gains going forward because they've rallied so much. But the yields are 4%, which is very respectable. So for the time being, I'm going to collect and I'm going to hold the income.
Fair enough. And why didn't you end up putting them in the vice president's portfolio? They're obviously non-Contra picks, so curious about that.
Yeah, volumes. Long story short, it's volumes. These preferred shares, they have very low volumes, and that's the primary reason. You could also say that if you're going to purchase the preferred shares in a name, you might as well purchase the common shares first, contra the herd as well. But truth be told, the main reason is low volumes.
Okay. Yeah, in that case, you didn't buy the common? I mean, is there a reason for that? Or?
Well, it crossed my mind for sure, but the common shares never got low enough for me to get interested. I realize now that they've run a long way, say 350 to 550 or thereabouts, but I guess you can't win them all, and that's the way it goes.
Fair enough. Well, speaking of small volumes, I recall you purchased Hammond Power Solutions. That was a few years back, and you wrote about it on Seeking Alpha. I see it's rallied nicely. Do you still own it? Or?
Yes, I still own it. I bought it at $571 back in 2018. I sold half of it earlier this year in April at $1170 something, $1173 I think. But it never became a Contra stock because, as you mentioned, it has low volumes. The market cap is around 100 million, but a significant amount of that is owned by the founding family, so there's even less available to the investing public. And for that reason, it never made it into the Contra portfolio.
Okay. And so what do they do? I mean, and why did you buy them? I guess while we're on the topic.
Yeah, those are good questions. So what they do, they are an original equipment manufacturing company based in Ontario, and they build a variety of transformer and power relay products for utility customers as well as large industrial, commercial, and residential power users. And the reason I bought them is that in 2018, it looked like a good company to me, but it also looked like they were going through a turnaround. And by a good company, I mean that their balance sheet was strong, They had good insider ownership and low valuations. But the turnaround part of it was they were taking large write-downs in Europe. The European play that they had hoped would work out was failing them badly, so they were beating a retreat from the European market and taking losses as they did so. And then in 2018, it was a tough operating environment as well because their prices were increasing, but they couldn't pass them along to their customers. So the combination of those two attributes meant that they lost money in 2018. Many investors fled the stock, and that's when I got lucky and picked up some shares.
Well, I'm glad it's worked out as well as it has so far. I'm guessing you're looking for a good amount of upside from here before you sell?
Yeah, I'd say so. I'm looking for it to be over 12.50 before I want to sell more, and we'll see if it gets there. In the meantime, I'm happy to collect the dividend and watch the quarterly earnings come in and just see how it goes.
Fair enough. So I'm wondering do you think this company is going to benefit from sort of more the macro trend of the electrification of the auto sector, given that they make transformers, I believe?
Yeah, short answer is yeah. They should benefit to a degree. They are already benefiting from the electrification of the vehicle infrastructure industry, displacing internal combustion engines. So I'm happy to see that. I haven't taken the time to really try and quantify how big of a deal that could be for them, but it's certainly having some impact on them already.
Right. Okay, good. Well, on the topic of batteries and electric vehicles, I think this is a good time to ask the polarizing question of what do you think of Tesla?
Yeah, fair enough. That is a polarizing question. I would say it's a great company. It has loved, sought after, and admired products, and you could argue it's an environmentally important company too, given that it's focused on trying to address climate change. But I've never bought it based on valuations, and then again, maybe I've been wrong not to, because obviously it's done very well, and I think that value investors in general struggle valuing growth, and that includes myself. So, it's something I haven't been interested in, but so far I've been wrong on it, and we'll see if I can get better at valuing growth in the future.
Well, it's awfully tough with valuing a growth company. I mean, there's a lot of assumptions that need to be made. So yeah, I wouldn't fault you for that. So thinking about corporate culture for a minute, I mean, what do you think about investing in a company that is run by someone like Musk?
But personally, I would be fine with that. To me, so many of society's big movers and shakers, they're talented, tenacious, and sometimes to the point where they appear outrageous or crazy or absurd or unrelatable. And Elon Musk fits into that category really, really well. I mean, he's a big mover for sure. He's tenacious and he's outrageous and he's hard to relate to sometimes. But, he's in good company there. Steve Jobs was like that. Jeff Bezos is definitely like that. Winston Churchill was like that. And then people outside of politics and investing are like that too. Like, Tiger Woods is kind of like that. Mike Tyson is definitely like that. Michael Jackson. So, I think being a little outrageous and being a big mover and shaker, I sometimes think it just goes with the territory, being a little bonkers. And as a result, I wouldn't personally mind. I'd be fine with it.
Good. Yeah, I mean, Musk has certainly had a big impact thus far. I mean, do you think his impact is going to be as big going forward over the next decade or two? Or?
That's a good question. I think so. I mean, the trend isn't our friend with climate change. So companies like Tesla and the Hyperloop idea that he has, those are trying to address climate change and create, just so coincidentally, they're going to create quieter cities in the process, which is nice. But yeah, so climate change could screw things up. So I think because of that, I think he'll have a big impact in the decades ahead. And then if you think of SpaceX, that could be a much bigger impact longer term as well. I mean, it's hard to think of something more ambitious than colonizing Mars. And it's also important if you think eventually if we don't get off this rock we call Earth, everything is going to die. And I don't mean like just you and me and all the humans, but I mean everything, all plants, all animals, everything will die. So, given that, it's probably important to try to get off the Earth. So yeah, he could have a big impact there. He's a little obsessed with AI, and that seems to be a big kind of forward-leading industry as well, and one that's full of hazards, and he seems to be one of the only people who's aware of those potential hazards. And then, cryptocurrency, who knows what the future will hold there, but he's obviously into that as well. And I'm skeptical about how crypto will shake out and work, but I also admire those who are trying to take away the monopolistic power of central bankers in determining what currencies people use to conduct commerce and trade. So, yeah, I think he'll have a big impact. You know, he'll be up there with probably the like of Edison. And if Mars is successful, if they colonize Mars, he'll be like Christopher Columbus or something crazy like that.
Yeah, he certainly has his hands in a lot of different pots, that's for sure. So still not interested in Tesla after all that?
Uh, I would say no, just because of the price. But again, I can't value growth that well, or I've proved to myself I can't. But at the same time, I mean, Amazon had a really rough patch in the early 2000s, and it's possible to see a future where that happens to Tesla as well. So, yeah, I don't know whether I'll buy it, but if I do, you'll be the first to know. I'll tell you, and you can laugh at me if you want, and we'll see how it goes.
Perfect, sounds good. So, I mean, I guess I've got to ask then. I mean, you know, what is it? It's a 800 billion valuation versus Ford, GM, that sort of thing in a $50 billion range. I mean, would you ever consider shorting it, or is it just too hard?
I wouldn't personally. I understand that a lot of people have, and a lot of people see a compelling short thesis. Many of them have been burned trying to do it. And as you know, shorting's not really something I'm interested in, although I really like and admire what short sellers do by and large. And there's actually a video that you and I have made on this channel about that. So as it stands right now, and has it stood since Tesla was a publicly traded company, it's something I have never thought of shorting, and something I've never really considered going long either.
Very good. Okay. Well, thanks for sharing those thoughts. Before we close out today, you'd mentioned you wanted to talk a little bit about investor psychology, and I think that's a very important topic. So I'd be curious to hear your thoughts on that. Maybe we can.
Yeah, so this is actually coming by way of a subscriber question, and the fellow's name is Paul, and he emailed Benj and I a few months ago, and he asked, let me pull it up. He asked, do you have recommendations for books on the psychology of investing? It's my biggest weakness, and now that I recognize this, I should educate myself to close the gap. So that's what he said, and to me that's an absolutely fantastic question, because I think it's everybody's biggest weakness. Regardless of if they care to admit it or not, everybody struggles with this. So props to Paul for recognizing this problem in his own trading and his own investing and seeking ways to improve it. And what I told Paul was that, in my opinion anyway, there are 3 good books and then 1 great YouTube video, which he can go and dig into. And the 3 books are Thinking Fast and Slow by Daniel Kahneman, Nudge by Richard Thaler, and Investing with an Irrational Mind by Robert Kupple. And I don't want to drone on about these books and everything they say. I mean, you can go read them for yourself if you're interested. But I would just say that, to me anyway, Thinking Fast and Slow is by far the best book on this topic. And it's a book that I actually reread every once in a while. I don't do that with many books. It's a book I skim and I keep on my bookshelf really close by just to have it handy. And it's a very useful book. So I think if you were to read that book and to try and be cognizant of the lessons in that book, I think it would serve you well.
Good, good. Okay, well, thank you. And the YouTube video suggested, what was that?
Oh, the YouTube video was a great YouTube video by Charlie Munger, and it was a speech he gave in the early 1990s. I think it was to Harvard or, a university class like that. And in my opinion, it's quite exceptional. It's quite long, but he really digs into many of the issues facing investors and actually politicians, and in any uncertain field for that matter. And he really gets into biases, really gets into how you can get into your own head. And I really like it. I would actually put it up there with Daniel Kahneman's book. If you went between the two, you read his book, you listened to that video, you'd be well served by doing that. And those two are really great resources.
Perfect, okay. Well, any honorable mentions in the book category on this topic?
I can't think of titles off the top of my head. I guess The Hour Between Dog and Wolf would be one. But there are other really good writers and thinkers on this topic. I mean, Ben Graham, Warren Buffett, Howard Marks, they've all written a lot on the topic. They all seem to get and understand the issues that investors face pretty well. But honestly, I think if you start with Daniel Kahneman's book and you read that, you give Charlie Munger a watch, you'll be in good form by doing those two things.
Excellent. Okay, that's great. Well, thank you for all your time today, Phil. Any closing comments before we wrap up?
Well, thank you, of course, for doing this. I always appreciate it. And I know some subscribers have reached out to me personally, and they seem to appreciate the content that we're producing as well. So much appreciated there. And the last things I would say to the subscribers are the quarterly will be mailed to you the week of October 18th, and December tax law selling season is coming up. And that's when we try to do most of our buying. No guarantees that we will do buying, of course, but we always give it a good shot to try and get something and buy a few names when everybody else is selling. So that's all I have for subscribers there.
Great. Okay. Well, something for people to look forward to. And yeah, be sure to subscribe if you haven't already. Thanks again for coming, Phil. It's great to have you here. Hi, everyone. I hope you enjoyed today's episode. If you'd like free access to our paid subscriber content, just click the link here and enter your email address here. And don't worry, we won't spam you, but if Contra does ever offer a major discount to the newsletter, we'll let you know. Otherwise, you'll just be receiving our premium video content through this channel. So we look forward to seeing you there. Happy investing.